This is me. My name is Cal. Again, I'm the mortgage sales manager here at Ideal Credit Union. I've been here for about 9.5 years now. And so one of my favorite parts about this job is educating first-time home buyers, second-time home buyers, you name it, if you're buying a cabin and whatnot. I'm here to help. So my job is to try to get you into your house as seamlessly as possible. And without you guys, I wouldn't be able to do what I do. And so this is me before LASIK, and so I got LASIK probably about 2.5 years ago. And like I said, it's been a fun journey so far, being able to help all of our members on my spare time. I have 4 little girls, so we like to go hiking, we like to go fishing, take the boat out, and you name it. So sports are a big thing right now with my family, as I'm sure all of you as well. And so that's a little bit about me. Today's goals, this is what I want, and hopefully you guys get some information from me here is, again, home buying basics, right? So I want to help you guys figure out what your numbers are in terms of what you can get pre-approved for. I want to talk a little bit about the different options that are out there that could be available for you, as there's a ton of different programs out there. And then last but not least, I want to make sure you walk away with a clear understanding of your next step. And I say that because everyone's journey is just a little bit different, meaning some people are ready to buy as of yesterday. Some people won't be ready to buy until next year. But everyone's journey is just going to be a little bit different based upon, again, where you are financially. Before we dive into all the basics of everything, I always like to talk a little bit about the market. The housing market is very interesting. Again, I've been doing this for probably 15.5 years. And the housing market has gone this way, this way, this way, and that way. And so it has been a really interesting journey. But right now, housing inventory is such a big part when you're looking to buy a home. So housing inventory basically put is the houses that are up for sale right now in today's market. The number two thing, mortgage rates and affordability. Mortgage rates continue to be kind of top of the topic in pretty much most of the news and the headlines. And so rates, we'll talk a little bit more about that, but rates continue to be right around that 6.5%, which is pretty normal at this point. And affordability is the other item that's on there. Obviously, the higher the mortgage rates, the more expensive your payments will be. And as we all know, affordability, inflation is a little bit tougher here as well. And so affordability will be a big thing. And last but not least, I want to talk a little bit about for your financial health. And so we're hoping that, again, in today's market, these are the big 3 things, in my opinion, that impact whether or not you're ready to buy a home. Charts are my thing, so I always enjoy looking at this. Again, I like to talk through this a little bit with you. This is the Minnesota Realtors housing market update as of April. So it kind of goes over what has happened from 2025 to 2026. And I highlighted the 3 things here that I thought were kind of important here. Inventory, which we talked about. So the new listings right there, the very top number right here for 10,868. That means in the month of April of just this year, 10,000 new listings came up. So it's a good trend because from compared to last year, we're up just shy of 10%, which is a good thing. Good thing for our buyers. You can see here the median sales price in this Minnesota market hasn't really changed. So it's kind of stayed right around that 360,000. And the data is a variety of whether it's single family homes, condos, you name it. And then this last but not least, this last one that I highlighted down here, months of supply of inventory, I like to pay attention to. This just means that if no new homes were listed in the market starting today, it would take about 3 months for all of the houses that are on the market to pretty much be sold. And so the real question that I like to answer for everyone is, are we in a buyer's market or are we in a seller's market? So I've broken it down to two columns here. So in a buyer's market, our buyers have more leverage than the sellers, which means there's more homes for sale than really there are people looking to buy a home. Homes tend to sell below or at the list price. And then homes, they take longer to sell because there are fewer people buying. In the seller's market, which is kind of where we're at right now, there are more people who want to buy a home than there are homes for sale. Homes often sell above the listing price because it's more competition, more multiple offers. Homes move quickly. So, sometimes in just a few days, the home will be sold. And then in a seller's market, we experienced this during COVID, but buyers like can only see the house once before the listing gets an offer. And so, again, very interesting market. I personally think it's a great time to buy if you're ready to buy, whether it's a buyer's market or a seller's market. I mean, it's just as long as you're comfortable. I think of it as you got to get into the home first, right? Rates are going to do what they want to do. The market will do what it wants to do. But as long as you're comfortable with the payment, um, and again, you get into the house. There's a saying, right? You date the rate, you marry the house. Um, get into the right house for you because like I said, there's not a ton of inventory. Like we are seeing it's a really good talking about this before again, like it's good trend. The trajectory is looking very good for again the housing market. Rates. This is fun. Mortgage rates are a big thing, and so we don't control it. And so it's kind of up to what's happening in the economic, like in the economy right now. So I always like to compare this year over year is what I like to look at. So if you looked at May 29 of 2025, the 30-year mortgage right up at the top here was just under 7%. Fast forward, you can see exactly what happened to rates throughout the year. It went down and then it climbed up in March and then it went down in April. And now we're kind of right back here where as of today, rates are at about 6.5%. So you're like, why does it matter? Right? Rates will be rates. Um, Rates impact you three ways, which more than of three ways, but these are kind of the big three things that I like to look at. They impact your monthly mortgage payment, they impact the purchase price, and then the interest, and then of course, last but not least, they impact the interest paid on the loan. So the higher the rate, the more interest you'll pay towards the mortgage. I'm a chart guy, so I like to kind of explore the different options here. And so I always like a visual as well. So if we looked at this and this chart last year around this time, if you were pre-approved for a $300,000 loan and your rate was 7%, your principal and interest payment would have been close to $2,000, right? So that's if that's what you're pre-approved for and nothing's changed and you haven't bought a house, we're gonna fast forward to we'll just say this year. Same loan amount, rate has gone down a little bit, and your payments have gone down over $100. So this is how the rate impacts you, right? So you could either still qualify for the same amount, or if your financial situation hasn't changed, you can probably bump this purchase price up like $20,000. So opens up a little bit of room in terms of qualifying for a house. And last but not least, what's becoming really popular is adjustable rate mortgages. Mortgages have tons of acronyms. And so adjustable rate mortgages, known as ARMs, are becoming more popular because what they offer is a fixed interest rate, a lower fixed interest rate for 7 years, right? Which means your payments are going to be much less over the first 7 years of the loan. After the 7 years, it can go up or down. So there's different terms. We'll go over some of those programs. But you can see here the savings is pretty significant. It's $300 a month you're saving comparison to like what it was last year. And so some people are choosing for ARMs. It's not for everyone. Adjustable rate mortgages, because again, people don't want to worry about, hey, what happens after 7 years? Give me 1 second. I'm going to check to make sure there's no questions or anything there. Perfect. Okay, so no questions. Good. Again, any questions, feel free to stop me at any time and type it in the chat or the Q&A box. Awesome. So we'll keep moving along here. So again, interest rates do impact you, whether, so if anyone says otherwise, that's not true. And so, perfect. So what we want to see is your financial health. So we've talked about the market. We've talked about the mortgage rates. And then now we want to talk about your financial health, which in terms is what we as loan officers look at is we look at 4 big things. So we calculate your debt to income ratio. We're gonna do a deep dive in that. We look at your credit score. That's a big part of it. We figure out what programs you might be that are out there that you might be best fit into. And then last but not least, we talk to you a little bit about the down payment and the cash needed for closing and what might cost you money upfront, and what's an affordable payment for you. So these are kind of the next few topics here. Um, I think it's really important now. So like the question I always get asked is, why should I start planning now if I don't plan to buy in a year or 2 years? Like, first of all, we got to figure out where your timeline is. So we'll strategize it. You know, if you're buying next year and you have no credit built, right? We can help you set you up with that. We can set up a secured credit card. We can get your credit score to where it needs to be to qualify for a mortgage. Meeting with one of the loan officers here at Ideal Credit Union is free, and then we can help you give you an idea of what you approximately qualify for. And last but not least, I think it's important, you know, buying a house is a very, very, it's a big task, right? So it feels a lot like you're taking a big loan out. And so our job is to reduce stress and really increase your confidence when you're learning about the different programs out there. Off the top of my head, I can think of probably like 20 different programs in just the state of Minnesota. And you're not expected to know it all. You can probably Google. Google is probably one of my best friends. And so you could definitely do that. But again, you don't know the parameters. And our job is to kind of try to figure out, again, the different programs that we can work with to help you get into your house. So meeting with you, we always want to ask you, you know, why do you want to buy a home, right? The why, everyone's why is just a little bit different. Family and future planning is huge. That's the reason why I rented 8 years. My rent was $800 a month. The landlord never rose the rent. I loved it. It was anything that broke, I could just call him. He would totally come out the next day and fix it. But I got kids, so I ended up, you know, we had two girls, and then we're like, well, it's not good to rent anymore. So then that was our decision to buy a house. And now that, again, we've got two girls, now we've multiplied that. Now we've got four girls, and so, but you got to figure out why you want to buy a house. So some people, their reasons are like they want to control the decisions around the home and customize it to how they want. You could be the first homeowner in your family. That's always a huge plus. Holidays will be spent over at your place, of course, because you're the first homeowner. Some people, I mean, it's really just to have a place for yourself and really future generations to call home. I mean, that's really as basic as that. And then last but not least, some people like to buy a home and use it as a long-term financial investment. So what I've been seeing a lot is people do some house hacking. They'll buy a duplex, they'll live in one side of it, and they'll rent the other side out, and their tenants will pay for their mortgage pretty much. And so, again, it just totally depends on what you are looking to accomplish. And that's, again, our goal is to help you figure out what that is. Some of the questions we'll probably ask you: where are you looking to buy, right? So Ideal Credit Union, we're located in Minnesota. We are licensed to do mortgage loans in Minnesota and Wisconsin. However, we have a partnership with a lender, Servient Mortgage, who they actually lend in 39 other states. So that's why I said location's important, right? You might not be looking to buy a first home. What if you're looking to buy a second home down in Arizona? Like, you know, we can help you with that too. But it just, again, we want to figure out what you're looking for. What type of home is going to fit your needs? Are you looking for a single family home? Are you looking for a town home? Maybe you want a condo. Maybe you don't want to do any of the artwork and you want the association to take care of everything. We will probably ask you when is an ideal time for you to start moving forward, whether it's in the next 3 months, 6 months, 12 months. That way we can just gauge and figure out, you know, what the best step forward for you would be. We also like to talk about price ranges, monthly payment range, kind of where you want to be around, right? So you're like, hey, I want to be around $1,500, but I don't, you know, but I want a house for 500,000. We'll probably, you know, talk you through it and tell you whether it's realistic or not. And then last but not least, helping you understand affordable payments versus the maximum budget. And we're going to delve into that a little bit more when we talk about debt to income, which is one of the big things we look at. But just because you can doesn't mean you should. Meaning if you came in and I told you you're approved for $1 million home, I mean, do you really want a $6,000 mortgage payment? Maybe you do, maybe you don't. But again, we just want to help you understand, like if your affordable payment's $3,000, we want to try to keep you around there. Um, because again, if you're wanting a more expensive house, I mean, you'd have to put more money down at that point to stay within that affordable payment range. So the three main factors that most lenders look at for a mortgage loan is DTI, which is what we call your debt to your income. And when we talk about debt, we really refer to anything that's reported on the credit bureau. So if you're talking about like your car insurance, for example, we don't count that. If you're talking about your life insurance, we don't count that. If we're talking about your water bill, your electricity bill, none of those are factored into this debt to income that we look at. Debt would mean like if you have a car loan, you have a student loan, if you have personal loans out there, those kinds of things, child support, alimony, those are counted as debt because you're required to pay those monthly. Credit is a big thing. So minimum credit score used to be 620 to qualify for a mortgage. They have now waived that for like a what we call a conventional mortgage. They'll just review your profile in full, meaning they'll look at how much you have for assets, how much you have for income and debt. And so the last thing we look at is assets, which is bank statements. We want to understand how much do you want to put down, how much are you comfortable putting down, if any, and will you have some reserves afterwards? So the big three things are debt to income, credit, assets. Credit and assets are pretty straightforward. And credit is when we pull your report, it's a quick, like, we get it within probably like 10 seconds, and we tell you exactly what the score is. Assets are pretty easy. We just look at your bank statements. I think the biggest thing that me and my team do is we look at your debt to income because, again, we want to make sure that you're comfortable with those payments. So this debt to income activity, I love to do this in person. We had one. I actually had a couple of them a few months ago, and the class really liked it. If you want to, again, tag along, it'd be great. You can help yourself calculate how much you qualify for. Again, this is a part of what me and my team do. So debt to income is simply how much do you owe monthly on your like credit cards, your student loans, your car payments, compared to how much you make each month. And when we say that, it's not your take home, it's your all that the money that you get before the taxes get taken out. So let's go ahead and calculate it. Hopefully everyone's still following along. Debt to income ratio. So we have this handy dandy debt to income debt to income ratio calculator. So in this scenario, I've got two borrowers, two members, right? They're both making $60,000 a year. So their combined income is $120,000 a year. So what we're trying to figure out is how much does this mean they're making each month? Because we're trying to figure out their affordable monthly payment. So up here, if they're both making $60,000, that means together they're making 120 grand a year. We take this amount, we divide it by 12 because there's 12 months in the year. And then out of this monthly amount, so this is saying before taxes are all taken out, combined, they make $10,000. What we do is we take this amount and we multiply it by 45%, which means that the maximum amount of debt they can have each month is $4,500. So in theory, if you didn't have any debt, you could probably qualify for a $4,500 mortgage payment. Now, granted, that's probably like a $500,000 loan, but it just depends if you want to spend that much each month. Now these borrowers have typical loans, right? So the borrower one has his car loan, he pays $500 a month. Borrower two has student loans and a car loan. They pay a total of $500 a month. So their monthly debt that they pay each month is $1,000. Again, this is what's reported on the credit bureau. If they're paying rent right now, we don't even include that because once they buy a house, that rent payment will cease to exist. It'll just be gone. So when we're looking at this financial picture, we're like, okay, well, out of the $4,500, we take away what their monthly debts are that they're paying each month right now, which means that down here, I apologize, that's kind of at the very bottom here, they can qualify for a mortgage payment of about $3,500, right? And so from there, me and my team, we look at that amount and then we convert that into a purchase price for you, depending on how much you can put down or depending on what program you want to qualify for. So in a nutshell, that's really what, again, our job is to make sure you can comfortably afford this payment. Some tips, again, when we did this in person, it was a lot of fun. Calculating income has always been, again, it just depends on how you're paid. If you have a salary, right? If you have an annual salary, say, hey, your annual salary is $60,000 a year, you just take that total amount divided by 12 months, you get your monthly income. The second way to calculate it is if you're paid weekly, biweekly, you take your hourly pay and you multiply it by the number of hours you're guaranteed every week. And then multiply that. So that'd be your weekly wage and multiply that by 52 weeks because there's 52 weeks in a year. And then that's going to give you your annual, and then you just divide it by 12 months. So some quick ways to calculate it. Again, it was a ton of fun to kind of have everyone crunch their own numbers. And then last but not least, if you're self-employed, so if you got personal tax returns, business tax returns, it's going to be a little bit more complicated than that, just because when you're self-employed, there's write-offs, there's things that you can count back in. But normally for self-employed borrowers, we look at the net amount, meaning like what did you pay taxes on? So you might have made like $300,000 in sales, but yeah, you might have made $300,000 in sales, but if you write everything off and your net income is only like $50,000 a year, that's what we're going to use. So perfect. I've got a question here. So did your $3,500 payment include taxes, insurance, principal, interest, taxes, insurance? Yes, correct. So the $3,500 on this previous slide would have to include the principal, the interest, the taxes, and the insurance. And so principal and interest is easy to figure out, right? We plug in the loan amount, we plug in the interest rate, it gives us exactly what those principal and interest payments will be. Taxes and insurance are a little bit more like it's an estimated guess because we don't know what the taxes will be at that time. We won't know how much your insurance is going to be at the time because you're at the very beginning of getting pre-approved. You don't have a property identified yet, so it's going to vary, but we will give you estimates on those. But yes, that $3,500 payment does include everything in terms of your payment. So great question. Some really easy strategies to lower your debt to income ratio. If you've got small debts with high minimum payments, pay those debts off, right? So if you've got like a credit card with like $1,000, we'll say you have $1,000 balance on it, but the minimum payments are like $200 or something. If you can pay it off, it's going to help you qualify for more house. Number two, avoid new debt before you buy a home. So we've seen this over and over again. Like someone will apply for a mortgage and then they'll be like, oh, I've been pre-approved. So you know what I'm going to do? I'm going to go buy a new car. Well, if you do that, we have to include that new debt towards your debt to income, which means that previously you might have been pre-approved for $300,000, but now that you've got this new monthly payment, new monthly debt, we have to take that monthly amount away from what you qualified for. So number three, increase your income. So side income counts. The one caveat I would put on that, there's an asterisk to it, is that if you have a side hustle, meaning if you do DoorDash, Uber, Lyft, you have to be working that side hustle a minimum of 2 years simultaneously along with your current job. So you got to prove that you've been doing that for the last 2 years and that it's consistent. And so just a couple of things that I like to put here. There's a big difference between what you're approved for and what you should spend. And then, like I said before, just because you can doesn't always mean you should. So it's, again, in this industry, it's pretty fun for me because I am able to help people get into homes. And a lot of what we do is we structure our loans very differently based upon your financial situation. So if you're like, for example, very high level, but if you're short funds for closing, we could increase your interest rate and then give you a credit back at closing. So you have some cash from the lender. So there's so many different ways we can structure, but it's about trying to get creative with it and helping you guys out. So monthly payments. So the question that was asked. So these are the components of your monthly mortgage payment. So four big things. There's a fifth one with an asterisk, but principal and interest, really important. That's what goes to the actual loan balance, and that interest is what goes to the lender or whoever holds the mortgage. Mortgage insurance is important. Mortgage insurance allows you to get into a home by when you put less than 20% down. The mortgage insurance, you guys pay for it monthly, but it insures the lender in case you were to default. And so the risk is we give you that big lump sum if you're putting like we'll say 3% down. We're taking majority of the risk, so we ask that you pay this insurance. So we have you pay this insurance to cover us. Property taxes are a big thing. So depending on what county you're buying in, the location of the area, property taxes are a must. In Minnesota, they're paid twice a year in May and October. But we do, part of your monthly payment is that we collect it from you. And then when it's due, we pay those so that you don't have to. The fourth item here, homeowners insurance. Again, very, very important. You want to make sure your house is insured inside and out because in Minnesota, for example, we've got tons of hailstorms, damages, but this insurance protects you and obviously it protects us as well, being that we hold the collateral under our name. But insurance is again really important, and insurance cost is usually between like $2,000 to like $3,000 a year. So the more expensive your house is, the more expensive the insurance will be, especially if you have more square footage and whatnot. And then last but not least, we have the homeowners association. Again, if you're buying a townhome or a condo, they insure, like the association takes care of like the maintenance, the lawn maintenance, and they insure the outside of the house. So you have an association that you pay each month as well. And that's why I said I think it's important to kind of get in and get a free consultation and talk through it. Because if, again, the payments will be different based upon the type of home you're buying. Any questions about debt to income or principal or the payments? I always like to pause right around this time because I know it's, again, we kind of fly through this. We're scheduled till about 7 o'clock, so I think we might end a little bit early, but if we don't, again, I will try to make it work because I want to be cognizant of your time. And so, perfect. No questions. Perfect. So credit's really important. So your credit scores will range anywhere between 300 to 850. So think of a credit score as like a universal financial reputation. If you pay your bills on time, you get a good score. If you don't pay your bills on time, your score starts to fall off, which means, it's a way for us to determine like trustworthiness as a borrower. Like, and it shows that you can pay back your loans and really help build your financial reputation. So again, previously we had a minimum credit score requirement of 620 for most of our loans, and now that they've taken that away, they just evaluate the overall profile. So I will say the higher your credit score is, the better deals that you'll probably get. The previous slide that we had looked at in terms of like mortgage insurance, right? So mortgage insurance, a few things influence that. How much you're putting down, and then really what your credit score is and what the type of property is. So the higher your credit score, it means you're less risky, right? Which means that each month your mortgage insurance will be not as expensive because with your credit score, it tells us that, hey, you've been doing a great job, an exceptional job of paying your mortgage on time or paying all your debts on time. You're not taking out more than you really should, and then you're not just paying the minimum at when the credit card statement comes due, you're paying more. And so credit scores, to get a good score, you usually have to have credit for about 2 years. But I have seen people get credit established in about 1, as long as, again, they're diligent in terms of applying for, having a couple credit cards, using it and paying it back. So I can give you a good example. My brother, he doesn't believe in credit scores. So he turned 26 and he wanted to buy a house. And I'm like, hey, are you going to apply? He's like, apply for what? And so we got to talking. He's like, well, I don't have a credit score. I cashed out my car. I don't have any student loans. I paid for all that cash. And I'm like, okay, so what's your credit score? And he's like, I don't know what it is. And so when we checked it, he had no credit score. So he was kind of like a ghost in the system, if you would. And he's like, it doesn't make sense. You got to have debt to get a good credit score. And I'm like, kind of not really. They just want to make sure you're able to pay back what you loan out. That's really what it comes down to. So again, it's important to have a credit score, a good credit score. Again, it doesn't mean you have to have perfect credit. It's just good to have decent credit so that when you apply for loans, you get a better leverage to get better deals. 5 big factors that affect your credit score. Pretty simple. So 35% of your actual credit score is your payment history. So how often are you paying your bills on time? 30% of your credit score is how much do you owe on the balance versus what's available to you. So if you have like a $1,000 credit card balance, or sorry, credit card limit, you want to make sure that, if you're maxing that out, that you're paying it down to where when the statement cuts over, it's less than 30% of that, of what's available for you. So the balance should be $300 or less. Credit age is important. So 15% of your score is how long and how old your credit lines are. So this is where it goes back to, I was saying, normally you want to have at least a 2-year credit score history to have a good credit score. 10% of your credit is the types of line of credits that you have. And when I say this, it's like they look at, for example, a credit card is what we would consider a revolving line of credit, meaning you can use the balance and then you have to pay it back each month and it becomes available for you again. There's installment loans, which are like car loans, right? So you get an amount for the car loan and you just pay it off, and then once it's paid off, it's done. So having a mix of types of credit helps your credit score. So, and then last but not least, how often are you applying for new lines of credit? So if you're going out there applying for like 10 different credit cards every single month, every time you apply for a credit card, it's going to negatively impact you, whether or not they approve you of that line. So some credit building tips that I've learned throughout my career here. Consistently making your payments is super important. Again, try to pay the minimum. I've seen a missed payment knock off more than 100 points on a credit score. So if you were at an 800 and you unfortunately didn't pay one of your credit cards, it could bring you down 100 points. So know your credit limits. Try not to charge no more than 30% of the limit. Avoid closing any accounts. So usually when you first establish credit, they give you a lower credit limit. Try not to close those accounts because those are the length of how long you've had credit for. So adding yourself to a spouse's older credit card can really improve your credit score. I've seen this as I feel like this is kind of like a hack. So if I added myself to my wife's credit card and she's had her card for like 20 years and has like a big balance on it, like it's going to help my score because I get all of her history and all of her payments as well. So, and then last but not least, utilize the free credit report monitoring. This is, again, it's free. You get one free credit report every year, and just make sure there's no frauds out there. Make sure there's no collection items. Those are like I said, those are really important as well to make sure, because sometimes weird things get sent to collections. Like I've seen like what is it, like an AT&T bill or something for like $200 that went to collections because the member forgot to pay it, and then it just out of sight, out of mind, and never stopped getting notices. But that can happen, and so just make sure that everything is correct and accurate on that. Oh. Savvy Money. So of those of you that are members of Ideal Credit Union, I'm going to see if this will work. Okay. Savvy Money is our credit monitoring tool that allows you to look at, you monitor your credit score. So it updates usually every week or so, but it gives you a high level overview of what your credit rating is. And so you can simulate things on there too. So if you're members, go to your app, or you have an account with us, go to your mortgage app. I'm sorry, not your mortgage app, but your Ideal CU app. and scroll all the way to the bottom, you'll be able to see that there's Savvy Money. It's free. It's free for our members, and so you can go there and monitor your credit report. But again, it's pretty cool. You can look at what you might be qualified for in terms of what you could, like new credit cards. You can simulate your credit score, which is super cool. Like you're like, hey, what happens if I miss this payment, or what happens if I increase my usage by this much? What would happen to my credit score? Super cool. Again, super good tools. And then it actually also has a debt to income calculator on there too. So good question. So yes, you don't have to be on the app to use Savvy Money. You can actually be right on the computer as well. So let me see. We're gonna try this to see if it works. So bear with me. I'm gonna stop sharing for a second, and then I am going to get to you guys here in 1 second. Oh, there we go. Okay, we're gonna share the internet. And I want you to show. I want to show you. Hopefully, everyone can still see me. So this is an example of what Savvy Money looks like. So this is what I was talking to you. This is a demo. So yeah, no worries there. So you can see what your credit score's at. You can see when it was last updated, May 19th. So like it's a weekly update. You can see the credit card usage, payments on time. Your credit score is good. But this is where I was talking to you about, like the credit score simulator. If you click there, it talks about like if you apply for a new credit line, what would happen to your credit score. Like see, so if you applied, you can see that the right side here. I'm sorry, I'm pointing at the screen, but my mouse is here. So the score went down because it's a hard inquiry, right? So you apply for auto loan. You can here, so close that, and so you can manage the balances, right? So if you increase your balance by 2,500 or 25,000, your payment credit score is coming down 50 points. And so again, super slick tool. Definitely recommend it. Again, you as long as you have an account with Ideal Credit, you can do it on the PC or you can do it on your app. So I just have it on my phone as an app because it's quick to access it. And so you can even do like this too, like missed payments. If you miss one payment, this is what happens to your score. If you miss 2 months, if you miss 3 months, yeah, that's pretty significant. So the other hint, and I'm going to stop sharing this now and I'll go back to my screen, but the other hint that credit billing tip, I should say, is that your credit cards, if you miss a payment, right? So you can actually miss a payment and it won't get reported to the credit bureau until you're more than 30 days late. So you could pay your credit cards 10, 15 days late. You might get charged a fee for it, but they won't report it to the credit bureau. So as long as you're not more than 30 days late, they won't report it. So again, super cool tool. If you guys don't have it, definitely take a look at it. Again, it's free. And so I use it every day. Again, it's very slick tool. And I think we just came out with it maybe a year ago. So we just partnered up with them. And so perfect. So we've talked a lot. So we've talked about debt to income. We've talked about credit scores. Now the fun part, right? So the hundreds of programs out there. So we're not going to go through each and every one. I'm going to go over some of the most popular. Conventional is the most common type of mortgage. I mean, conventional, just think of that as a loan, like a mortgage loan. It's the most basic one. We offer FHA and V loans, both federal, like government loans. Very flexible underwriting. VA loans are for veterans, so we do offer those here as well. So if you're serving the military, Air Force, you name it, we can help you with that. VA loans are super awesome because you can finance 100% of the loan, 100% of the purchase price, and you don't pay any mortgage insurance. So super amazing program for our veterans. We offer adjustable rate mortgages. I know we talked about this a little bit, but ARMs are starting to become more popular. And a big reason behind it is that people are realizing that it's not very common to have a mortgage for 30 years and not do anything on it anymore. So the average lifespan of a mortgage is now between 7 and 10 years before life happens. Meaning you move, you have kids, you upgrade, maybe it's to start a home, job, relocation. So 7 to 10 years is the average lifespan that a person has their mortgage. So we'll go over some of these programs, and then we also have a zero down program, which has started to become very popular as well. So we can offer you. So if you put it this way, you can buy a house without putting any money down. So we called it the zero down program, but really what it is it helps you build equity faster. So let's go through this, and then, like I said, I can more than happy to open it up with any questions. So again, conventional FHA, VA loans, again, very common types of mortgage. We will always explore all three options for you, but we start to kind of throw a couple of them out if they don't fit within like your criteria. And so the next slide, jump to it too early, adjustable rate mortgages. So what is an adjustable rate mortgage? I think education is great. It's critical. I think it's another tool in your toolbox as a buyer, as a home buyer. So an adjustable rate mortgage is, the acronym is an ARM, right? So you can see here, there's a bunch of numbers. There's a 5-1, a 5-5, a 7-1, 10-1, and a 10-5. And you're like, what is all these? What does it mean? So how do they work? So that first number, so we're going to look at this 10-5, for example. The first number means the rate is fixed in for this amount of years. So it's fixed for 10 years. And the second number means how often will the rate change after the fixed period. So this 10-5 means after 10 years of your rate being locked in, it can then go up or down based upon where the market is at for interest rates. So if 10 years goes by and the rate is exactly the same as when you locked it in, nothing happens and the rate locks again for 5 years. And then on year 16, it can then go up or down again. So all of our ARMs are 30-year terms. So if you look at this 10-5 ARM, it's going to adjust a minimum of 11, 16, 21, 26. So like adjust the number 4 times. So the shorter the locked period of term, the lower the initial interest rate. And so, because obviously the riskier it is on your part in terms of like, hey, after 5 years, the rate can go up or down. And so I'm going to take a quick drink here. So why an ARM, right? That's the $1 million question. So it's going to offer you a lower interest rate, which means a lower monthly payment, which means less interest paid up front. Back at the very first beginning, like I think I was kind of showing you the mortgage rates. So the 7 ARM had a monthly savings of like $350 a month. So just think about that, $350, multiply that by, here, I got a calculator right here, $350 times 7 years, right? 84 months. You're saving almost $30,000 the first 7 years that you're there. And then you're like, okay, well, I could do a lot with that money. Because again, it's lower payment and less interest that you're paying up front. And so, yeah, again, great product. You don't have to remember or know anything. It's just, again, a tool in your toolbox. And our ARMs do have a bonus feature. And so you don't have to do anything about this. If the rate is reduced during your fixed period, I mean, we can reduce it without having to refinance the whole thing for you. And so our zero down program becoming very popular as well. This is a 25-year term, so your payments are a little bit higher, but you're coming to closing with no money. Like it's no like zero money down. I shouldn't say no money because there are closing costs. And so, but it's a 25-year term, and a lot of people are applying it with our ARMs, right? So like if you do a 10-5 ARM with this, it's going to only adjust 11, 16, 21 like 3 times. So why zero down? So you build equity faster, you're going to pay off the loan a lot quicker, less cash up front, and then less interest over the life of the loan. So super competitive and popular program right now. Again, everyone's situation is a little bit different. So it's not about, again, trying to force you into a program you don't like. It's about trying to figure out the best way to move forward for you. So we also offer here down payment assistance programs. So we partner with Minnesota Housing Finance Agency. So if you're needing assistance with down payment, they give you, there's 2 different types of down payment programs, both up to $18,000. but the first one's a monthly payment loan. So just think of that as like a secondary loan to your house. You make a monthly payment on it for 10 years, and then after 10 years, it's paid off. The second one is more popular. So it's a deferred payment loan, which means that they give you $18,000 for your down payment or closing costs. You don't pay, there's 0% interest. You don't pay anything each month. And then at the end, when you pay off the whole mortgage, you then have to pay the $18,000. So again, more popular, but has and I put on here the income limit. So any down payment assistance program that you want to explore or want to look into all have income limitations, meaning you can't make more than the amount that they've set out there for. So the monthly payment loan, for example, if you and your spouse make more than $142,000 a year, then you won't qualify for it. And then for the deferred payment loan, if you and your spouse make more than $89,000 a year, you won't qualify for it. So if you want to know more about that, I mean, we have a couple other down payment programs out there too right now, but this is probably our most popular one. Awesome. So we've talked debt to income, we've talked credit, we've talked quite a bit about payments. So what's the true cost for a mortgage? And this screen is super crazy. And so these are kind of all the fees that could be associated with a loan. All right. So this is we're looking at and I'm going to go through here. We're looking at someone who's buying a $350,000 house and they're putting 5% down. All right. Estimated monthly payment right here of $2,700, $2,800. Again, the taxes, the insurance, and the mortgage insurance are all estimated. So don't quote me on any of that. And so, but I wanted to talk about the different sections of these closing costs and these prepaid items. And so a lot of consumers, they shop, right? They shop mortgage companies, they shop the best rate, the best fees. And I think that's awesome because I think you got to do your due diligence because those are funds that are coming out of your pocket, right? And so the biggest thing that people shop for is how much is this lender charging for an origination fee? And when we say origination fee, that's just the money that comes to the credit union, comes to the lender directly. So it helps keep, our lights on, pays the bills, allows us to be able to give back with our low rates. So that's origination fee. So Ideal's origination fee, we charge 1% of the loan amount we charge 1% of the loan amount and we cap it at $3,000. So in theory, if it was 1%, it should be $3,032.50. Yeah, sorry, $3,325. Got confused there. But we don't, again, we have a cap to our origination fee. However, we do have a processing fee of $300 as well, which covers like automatic verifications of employment and whatnot. So most people will shop origination fees. There's bulletins here on the left side. So discount points are optional. Discount points, it's just a fancy way of you can choose to pay money to buy down your interest rate. That's all it is. And so you just want to make sure that when you get this document from a lender, they don't have these points, like they don't have anything in this section for you to get the rate that they've quoted you. That's what you want to see. So we don't charge discount points unless you want to buy down the rate. And so number 2 and number 3. So number 2 are third-party charges that you won't be able to avoid and they're all very important as well. So when you're buying a house, we always do an appraisal. So we always make sure that the house is worth what you're paying for it. Appraisal is charged to us. We'll pass it on to you. Same thing with the credit report. So if there's a cost to pull your credit, so our third party charges us, we pass it on to you. Title charges are really important. So the title company handles the transfer of the seller's name to your name. And they handle all the money as well. So during closing, you're going to write one big check out and the title company disperses all of these funds to wherever it needs to go. So Title companies have their own fees because again, they have to close the loan, they handle the monetary, they make sure the title is free and clear. So just think of it as like if you're buying a car, right? You got the loan and then you've got the title of who owns the house, owns the car. Same thing with the house, except it's not a physical like title. It's all recorded through the county, which is where you see these recording fees. And so can't avoid that either unless you're like buying in Wisconsin. So, and then the third item that not a lot of people like want to talk about, it's not closing costs, but it's setting up your escrow. So we're going to consider escrow as it's just an account. We're setting up an account to put money in. So every time you make a payment to us, we put a little bit of your payment into this escrow account so that when it's time to pay those, we just pull money from that account to pay it. That's all it is. But we still have to set it up because, as we all know, every year your insurance goes up. Every year your property taxes go up. So that's number three. So if you're buying, this example is again very high level. So if you bought a $350,000 house with 5% down, your closing costs will be about $7,700, and setting up the escrow will be about 51. So your total cash to close, and again I apologize for this, it's about 30,000, assuming you're putting 5% down. So that's what it looks like. And that's some of the details we go over with you because again, we'll tailor it to again what you're approved for, what you really again, what the price of the home you're looking to qualify for. And so again, very high level. Home buying tips. We talked about this. If you're pre-approved, don't go out to apply for new credit. So when you get pre-approved, we do monitor your credit report for new credit pulls because we're required to, in case you go and apply for a new debt, because we have to reassess it if you get a new car loan. So continue making payments on time, super important as well. I know sometimes what I've seen is members will get pre-approved and then they go and they're like, oh shoot, I forgot to pay this bill or this credit card and now my credit's gone down. Again, make sure you're paying your payments on time. Moving money around can require more documentation. So, wherever the money is sitting at in your bank accounts, just leave it there. We'll get the statements, we'll verify it. If you move it around, then we have to kind of chase it. And then last but not least, don't quit or change your job. I've had this happen before too. Changing your job is okay. Again, we just have to get more documentation. That's all it is. And don't quit. If you quit, we got you pre-approved based upon like your current financial situation. So if you quit and you're not working anymore, there's no income for us to use to qualify you. So we're getting close. I appreciate your time, everyone. Again, I think we got 5 minutes left, so I guess we did take the full hour. So the application process is really similar, like very simple. So at this point, we've talked to you about almost everything that we are going to be going over when we meet with you, right? Talked about income, we've talked about credit, we've talked about assets, programs you might be eligible for. The application process is really just plugging in your information. Name, social security number, date of birth, how much are you making? Like we collect your income and assets to verify that everything you've told us is true. Technology is crazy and really advanced these days, so sometimes we don't even need to collect pay stubs and W-2s at this point. Our pre-approval process, we just do a soft credit check now, so it doesn't count as like a hard inquiry. So no cost to you. And then once we have your soft check and we review all your documents, we'll personalize that loan specifically to your financials. And so we'll review your estimated monthly payments, what your rates are, cash needed at closing, what the closing costs are. And then we issue you a pre-approval letter. So this letter states that you are qualified for this much, so this purchase price, assuming you're putting 3% down, 5% down, whatever it might be, and that we have reviewed your income and your credit. And then there's stipulations as to like if there's anything that changes with your financial status or if like you go out and accrue debts. So the letter will show a realtor that you are serious about home buying. Once you've got the letter in hand, you can start your home search. I think that's the best and the most fun part. because no one dreams about getting a 30-year mortgage. No one's like, hey, you know what? I want to go and apply for a $300,000, house, and I can't wait till I'm 50 and I'm going to be paying it off. That's not the dream. The dream is to get you into the house. So once you're pre-approved, you get to contact a real estate agent. You get to start the house hunting. You get to figure out what your wants are, what your needs are, whether you want a townhome, maybe you want some acreage, maybe whatever it might be. So that's the fun part. Your real estate agent becomes your best friend. So one thing to keep in mind, if you saw the closing costs, your real estate agent does not get paid until you close on your house. And they normally get paid from the seller anyways. So you're not paying your realtor anything. They're really working for free. So give them some grace. And so they do work hard and helping you figure out the right home for you. And so again, so that's the basics of home buying. I know that was not really basic. And so, but that's what we look at. And like I said, I think it's important to understand it. And I feel like you guys here are here, so which means you're savvy, you're educating yourself, which is awesome. Incredible to see that. And so your next step is, if you're ready to begin, you can apply to get pre-approved. Again, you're not negatively impacting yourself in any way. You can apply right on our website. If you need more guidance on loan programs, I'm telling you, schedule a free meeting with one of our loan officers. Totally free. We meet with you, we plan it out, whether it's today, tomorrow, maybe next week, but again, it's free to meet. There's no cost to it. And that's whether you're a member or not. So you don't have to be members here. You can just go to right on our website and set up an appointment, and we can discuss on, again, your situation. So, and if you're not sure where to start, just give us a call. Again, we want to walk through it with you together. I always say this is like the mortgage payment, you are responsible for it. So not us, even though, like I said, the loan might be with us, but we want to make sure you're comfortable with those payments. We want to make sure that you're comfortable with the terms that you want to, dive head in. So perfect. Well, it is 6:59. Does anyone have any other questions? Bear with me here for me. I just wanted to end by saying thank you guys so much again for attending. I really appreciate it. This is my contact information. If you guys, again, we would love to hear from you. If you're ready to apply or wanted to chat more, happy to connect with you. Otherwise, like I said, I hope you guys found this helpful. And again, have a wonderful day. If you're here in Minnesota, my God, the weather is so nice outside. So go enjoy some of the weather, and hopefully, like I said, we'll connect with you all soon. So, all right. Thank you, everyone. Take care.